Hello everyone, welcome back to the channel. As every Friday, I give you a detailed analysis of this company. Before we close the chapter on this week, I've prepared some important notes that I'll be sharing with you in just a few moments. Before we start, I really appreciate those of you who recently subscribed. You're part of a small group right now, and I invite anyone watching who hasn't subscribed yet to please hit that button. It truly helps me keep bringing you this analysis. Let me tell you exactly what I'm covering today so you know what to expect. First, I'm going to explain the massive market rebound we're seeing after the brutal tech sell-off and why this changes the entire game for SoFi. Second, we'll do detailed fundamental business model for this company and why it's uniquely positioned in the fintech space. Third, we'll look at the fresh institutional buying data that just came out showing who's been accumulating SoFi shares behind the scenes. Fourth, I'll walk you through the live SoFi options chain with specific trading strategies you can execute right now at these price levels. Fifth, I'll share 3 complementary stocks with similar fundamentals that you should seriously consider. And finally, I'll give you my honest price target for SoFi and whether this is the moment to load up or wait. Alright, let's talk about what happened overnight and this morning, because this is huge. Stock market futures turned green across the board. The S&P 500 is up about 0.5%, the Nasdaq roughly 0.7%, and the Dow around 0.8%, a complete 180 from yesterday's sell-off. Tech, which has been getting hit all week, is finally showing signs of life. The Nasdaq was down nearly 4% before this bounce, and both the S&P and Nasdaq had slipped into negative territory for the year after recent all-time highs. Dip buyers are stepping in, led by chip makers like Nvidia and memory stocks. Even Bitcoin rebounded above $68,000 after touching a 16-month low overnight. So what triggered the panic? 2 main things. First, Amazon announced $200 billion in AI infrastructure spending this year, which raised concerns about whether these massive investments will generate real returns. Amazon stock dropped 9% on the news. Second, Alphabet said it will spend between $175 and $185 billion on AI, nearly double last year's level. That sparked investor worries about whether AI spending is productive or simply burning cash. But here's what changed overnight. Big tech CEOs and analysts started pushing back hard on the AI disruption fears. They're saying the concerns are way overblown. Look, the world economy needs to be robust enough to handle the challenges that AI brings. But AI is not going to destroy every software company overnight like some people were predicting. Microsoft had decent earnings. Meta had solid results. Apple came in fine. The sell-off was driven purely by fear, not by actual deteriorating fundamentals. Now for SoFi specifically, this broader market context matters enormously. When the Nasdaq is getting destroyed and tech stocks are in free fall, fintech companies get dragged down even when their business is performing exceptionally well. SoFi closed yesterday around $20.67, down over 6%. But we're seeing a real bounce in pre-market trading right now. It's trading in the range of $20.80 to $21.10 as I'm recording this. Before we get into the options and institutional data, I want to spend a few minutes on SoFi's fundamental business model, because understanding what this company actually does is critical to making smart investment decisions. A lot of people think SoFi is just another online lender, and that could not be more wrong. What SoFi has built is actually a comprehensive financial services ecosystem that's fundamentally different from traditional banks and even most fintech competitors. SoFi operates through 3 main business segments, which is exactly why I'm bullish long term. The first is lending, where SoFi started, offering personal loans, student loan refinancing, and mortgages. In the most recent quarter, this segment generated $481 million in revenue, up 23% year over year. While some may say 23% growth isn't impressive, the quality here is what matters. The average borrower has a 746 FICO score and earns about $158,000 annually. These are prime customers, not subprime. Charge-offs fell to just 2.8%, down from 3.37% last year, meaning credit quality is improving even as the business grows. That's exceptional execution. The second segment, and where it really gets exciting, is financial services. This includes checking and savings, SoFi Money, investing, credit cards, and crypto trading. In Q4, this segment generated $327 million in revenue, up a massive 57% year over year. This matters because these are high-margin, capital-light businesses. SoFi earns interchange fees when users spend, trading and asset-related fees when they invest, and spread revenue on crypto without taking on significant credit risk. Margins here are far higher than in lending. The third segment is the technology platform business, and this is honestly the most underappreciated part of the entire SoFi story. Through their acquisition of Galileo and Technisys, SoFi now provides banking infrastructure as a service to other financial institutions and fintech companies. Companies like Chime, Revolut, and dozens of others use SoFi's technology platform to power their own products. In the most recent quarter, this segment processed over $534 million in revenue, up 57% year over year. The platform now handles over 3.4 billion in monthly transaction volume across more than 150 million accounts. And here's the beautiful part. This is pure software as a service revenue. There's almost no variable cost associated with processing additional transactions once the infrastructure is built. As this business scales, the incremental margins are absolutely enormous. What truly sets SoFi apart is the flywheel between its three segments. Members often start with a loan, then open a checking account for a rate discount, add a credit card, invest through SoFi Invest, trade crypto, and even refinance a mortgage, all within one ecosystem. Every added product increases lifetime value and reduces churn. Today, the cross-buy rate is 40%, meaning 40% of SoFi's 12.6 million members use at least two products, up from 35% a year ago. As that rate moves toward 50% and beyond, the unit economics become extremely compelling. SoFi also has a major advantage most fintechs don't: a national bank charter received in early 2022. This allows them to hold deposits directly instead of relying on third-party banks. Those deposits give SoFi cheap funding, borrowing at 1 to 2% instead of 4 to 5%, boosting margins and profits. Last quarter, deposits hit 8.3B, up 34% from 6.2B a year ago, essentially free capital for lending growth. The bank charter also brings regulatory credibility, letting SoFi launch new products and enter markets on its own, keeping full revenue and control over the customer experience huge as they expand into business banking, wealth management, and insurance. Eric Schopenhauer just bought 5,000 shares, small but directional, showing smart investors are still buying. Even more telling, an EVP purchased nearly 100K of stock yesterday. On top of that, Jones Financial and SBI Securities are adding shares. Fresh data from the past day or two shows institutions accumulating while retail panics. That's the game. Fear from retail, buying from institutions. Headlines are now asking, is this stock worth betting on? Now, let me walk you through the live SoFi options chain, because this is where you can actually make money if you understand what's happening. I'm looking at real-time options data right now with SoFi trading at 2083, and I want to give you specific strategies based on current pricing. Understanding how to use options on SoFi is critical because the implied volatility right now is elevated, which creates both opportunities and risks. If you're bullish on SoFi, the Feb 28-21 calls trade around $0.63. That gives you the right to buy at $21 with a break-even of $21.63. Max loss is $63 per contract, but if SoFi hits $25, these calls could be worth $4, giving over 500% return. The February $20 strike calls, which are currently in the money, are trading around 1.25 to 1.35. These have much higher probability of profit because SoFi just needs to stay above your break, even of approximately $21.30 by expiration. If you think SoFi is going to grind higher over the next 3 weeks, but you're not looking for a massive move, these are safer than the out-of-the-money strikes. The delta on these is probably around 0.65, meaning for every dollar SoFi moves up, these calls gain about 65 cents in value. Now, if you want to give yourself more time for the thesis to play out, the March 21st expiration calls are really interesting. The $22 strike calls for March are trading around 1.05 to 115. This gives you 6 weeks for SoFi to recover back toward the mid-20s. Your break-even is approximately 23.10. If we get positive Q1 guidance in late March, or if there's news about S&P 500 inclusion, SoFi could easily be trading at $26 to $28. At $26, those calls would be worth at least $4, giving you roughly 250% to 300% return. The March $23 strike calls are cheaper at around 70 to 75 cents, but they require a bigger move to be profitable. For April expiration, which includes first quarter earnings at the end of April, the $22 strike calls are trading around $1.50 to $1.60. The April $24 strike calls are at approximately $1 to $1.10. Going out to April gives you almost 10 weeks for the thesis to play out. This is my preferred expiration if you're playing for earnings because you capture the entire earnings cycle plus any pre-announcement momentum. The risk is that time decay accelerates in the final 3 weeks before expiration, so you need to have a plan to either take profits or roll the position forward. On the put side, this is where it gets really interesting for income generation and strategic positioning. The February 28th $19 strike puts are trading at approximately 15 to 20 cents. If you sell these puts as cash secured, you're collecting that premium and agreeing to buy SoFi shares at $19 if the stock drops below that level and you get assigned. Your effective cost after collecting the premium would be around $18.80 to $18.85. At those levels, you're buying SoFi at a valuation that's frankly absurd given the fundamental growth trajectory. If SoFi stays above $19, you keep the 15 to 20 cents per share as pure profit. That's about 1% return in 3 weeks, which annualizes to over 15%. The February $20 strike puts are trading around 35 to 40 cents. Selling these cash secured puts means you collect that premium and potentially buy SoFi shares at an effective cost of $19.60 to $19.65. I find this particularly attractive because $20 feels like strong technical support, and if we do dip below it briefly, the $19.60 entry is outstanding. The probability of SoFi closing below $20 in 3 weeks given the current market rebound is maybe 30 to 35% based on the options pricing. For March expiration, the $20 puts are trading at approximately 60 to 65 cents. This is really meaningful premium. If you sell 10 contracts, you're collecting $600 to $650 over the next 6 weeks. If SoFi stays above $20, that's pure income. If you get assigned, you're buying at an effective cost around 19 to 35 to 19 to 40, which I would consider an absolute gift. The March 90 strike puts are trading around 35 to 40 cents. The March $18 puts are cheaper at about 18 to 22 cents. These deeper out of the money puts are for conservative investors who want income but have very low risk tolerance for actually being assigned shares. Now let me give you my specific SoFi option strategies at these levels based on different investor profiles. Strategy number 1 is for aggressive bulls who think SoFi is going significantly higher. Buy the April $22 calls for approximately $1.50 and simultaneously sell the April $26 calls for about 60 cents. This is called a bull call spread. Your net cost is 90 cents per share or $90 per contract. Your max profit is $4 per share or $400 per contract if SoFi closes above $26 at April expiration. That's 344% return on your capital at risk. Your break-even is $22.90. Your max loss is limited to the $90 you paid. This is how you get leveraged upside with defined risk. Strategy number 2 is for investors who want to build a long-term SoFi position at better prices while generating income. Sell cash-secured puts at the $19 or $19.50 strikes for March expiration. You're collecting premium every month, and if you get assigned, you're establishing a position at valuations that are genuinely cheap based on fundamentals. Then once you own shares, you can start selling covered calls at the $24 or $25 strikes to generate additional income. This wheel strategy can realistically generate 2% to 3% monthly income if executed consistently. Strategy number 3 is for current SoFi shareholders who want to reduce their cost basis and protect against additional downside. Sell covered calls at the 23 or 24 strikes for March or April expiration. At current prices, you can collect around 70 cents to $1 per share. That premium cushions any further downside. If SoFi rallies above your strike and shares get called away, you've still made a nice profit. Many investors then use that capital to sell cash-secured puts and get back into the position at lower strikes, creating a continuous income cycle. Strategy number 4 is a more sophisticated approach for experienced options traders. Buy the March $21 calls for around 85 cents and finance part of that cost by selling the March $25 calls for approximately 45 cents. Your net cost is 40 cents per contract. If SoFi rallies to $25 or higher, you make 360 cents on a 40-cent investment. That's 800% return. Your break-even is only $21, $40. The trade-off is your upside is capped at $25, but given SoFi is trading at $20.83 right now, that's still over 20% appreciation plus the option leverage. Strategy number 5 is for income-focused investors who don't want to own shares but want to generate yield. Sell iron condors by selling the $19 put and $24 call while buying the $18 put and $25 call for protection. You collect net premium from selling the closer strikes, and your risk is defined by the long options you bought. As long as SoFi stays between $19 and $24 through expiration, you keep all the premium. This strategy works best when you think SoFi is going to trade sideways for the next few weeks. One critical thing to understand about SoFi options right now is the implied volatility. The IV on near-the-money options is running around 65% to 75%, which is elevated compared to the historical average of around 55% to 60%. This means options are more expensive than normal, which is bad if you're buying options, but great if you're selling options. If you're bullish and buying calls, you're paying up for volatility. That means you need SoFi to move higher faster to overcome both time decay and potential volatility contraction. But if you're selling puts or doing spreads, that elevated IV means you're collecting more premium than you would in a normal volatility environment. The elevated IV also tells us the market is pricing in uncertainty around SoFi, which makes sense given the recent sell-off and upcoming catalysts like Q1 earnings. Let's focus on lending. Traditional banks are tightening, with credit card delinquencies at 8.8% and student loans at 14.41%, the highest since tracking began. But SoFi is different. Their charge-off rate is just 2.8%, down from 3.37% a year ago. The average borrower has a 746 FICO score and earns $158,000 professionals with strong, stable incomes, not subprime risk. There's talk of capping credit card rates at 10%. If it passes, traditional card issuers would be hit hard, but SoFi, with its fixed-rate personal loans, could benefit massively. Consumers would likely move billions from credit cards to loans, and SoFi is perfectly positioned to capture that flow. Now let me give you 3 stocks with similar characteristics that I think you should seriously consider buying right now. These are companies growing fast, improving margins, trading at reasonable valuations, and operating in sectors with strong tailwinds. Stock number 1 is Robinhood. They just reported strong Q4 results with accelerating revenue growth and expanding EBITDA margins. thanks to retail trading and crypto adoption. Trading at about 20x forward earnings, they're moving from pure transaction revenue towards subscription and interest income. Gold membership is scaling, and new features like retirement accounts and credit cards are coming. For anyone who believes in democratizing finance, Robinhood is a solid complementary holding. Stock number 2 is Moderna, ticker mRNA. I know this seems totally different, but just hear me out on this one. Moderna is a pharmaceutical company that's been absolutely beaten down from its COVID highs. The stock is trading around $40 to $45 right now, down from over $400 in late 2021. That's a 90% decline. But here's why I genuinely like it at these levels. Moderna has this massive pipeline of mRNA vaccines and therapeutics that go way beyond COVID. They're working on cancer vaccines, RSV vaccines, flu vaccines, personalized medicine applications. The technology platform is proven. It works. The market is currently pricing in literally zero value for the entire pipeline, which to me is completely absurd. Analysts are estimating Moderna could generate $10 billion to $15 billion in revenue by 2028 from non-COVID products alone. At a $15 billion market cap today, you're essentially getting a potential biotech home run at a massive discount. I like this one because it gives you exposure to a completely different sector, healthcare, which historically tends to be much more defensive during periods of economic uncertainty. Stock number 3 is Taiwan Semiconductor Manufacturing, ticker TSM. TSMC is the world's largest contract chip manufacturer. They make chips for Apple, for Nvidia, for AMD, basically every major tech company on the planet. The stock has pulled back with the broader tech sell-off recently, but the fundamental business is absolutely rock solid. TSMC is investing over $40 billion in new manufacturing capacity to meet AI chip demand. They have a technological moat that's virtually impossible for any competitor to replicate. The precision and scale they operate at is unmatched. The stock trades at roughly 22 times forward earnings for a company that's growing earnings at over 20% annually. I like this one because it's a pure play on the AI infrastructure build-out that literally everyone is talking about. Whether it's Amazon spending $200 billion or Alphabet spending $185 billion, a huge portion of that money ultimately flows to TSMC for the actual physical chips. So those 3 stocks give you really nice diversification. Robinhood for additional fintech exposure, Moderna for healthcare and biotech upside potential, and TSMC for semiconductor and AI infrastructure. They all maintain those high growth, high margin characteristics while spreading your risk across different sectors. Now let me give you my completely honest assessment of where we are right now. At 2067, the stock is down 37% from the November high of 32.73. We've been in this brutal sell-off for over a month now. But here's the thing, the fundamental business has not deteriorated at all. Actually, the fundamentals have significantly improved. Fourth quarter revenue came in at $1.13 billion, up 37% year over year. Management guided for 30% revenue growth in 2026 and 54% EPS growth. EBITDA margins are expanding from 29% to 34%. That's 500 basis points of margin expansion, which is exceptional operating leverage. Personal loan charge-offs fell from 3.37% down to 2.8% year over year. Credit quality is improving, not deteriorating. The valuation right now is genuinely cheap in my professional opinion. At $20.67, we're trading at approximately 34 times forward 2026 earnings. We're at about 14 times enterprise value to EBITDA. For a company growing EBITDA at over 50% with expanding margins and excellent credit quality, 14 times EV to EBITDA is frankly absurdly cheap. High-growth software companies with comparable metrics trade at 25 to 35 times EV to EBITDA. The institutional buying data confirms that smart money is accumulating shares right here. JP Morgan upgraded to overweight with a 30 model price target right after the sell-off. BlackRock added 13.5 million shares. We're seeing fresh filings literally every single day showing institutions and company insiders buying. The market is presenting you with a genuine gift if you have the conviction to take advantage of it. Now, I want to be realistic with you about near-term risk. Could the stock go lower from here? Yes, absolutely it could. If the broader market rolls over again, or if there's sector-specific bad news, we could definitely test the $19 to $20 level. We might even briefly dip below $19 if there's real panic. But I genuinely do not believe those levels would be sustainable for more than a few days or maybe a couple weeks at most, given the fundamental strength of this business. Here's my price target, and I want to be both optimistic and realistic with you. My base case target for the end of 2026 is $40 per share. That represents approximately 93% upside from current levels. Now let me explain how I get there and why I think it's achievable. If the company delivers on their 2026 guidance, which calls for $4.65 billion in revenue and $1.6 billion in EBITDA, and if the market gives them a 20 to 22 times EV to EBITDA multiple, which is still a discount to comparable high-growth companies, the math gets you to a market cap in the $45 billion to $50 billion range. Divided by approximately 1.3 billion shares outstanding, that's $35 to $40 per share. If they beat guidance, which they historically tend to do, and if we get S&P 500 inclusion, which creates technical buying from index funds, $40 becomes very realistic. My bull case: if everything goes right, execution continues to be flawless, margins expand beyond 34% toward the high 30s, and market sentiment improves meaningfully, I could see this stock at $50 to $55 by late 2026 or early 2027. That would put us back near the all-time highs with much stronger fundamentals supporting the valuation. My bear case: if we get a genuine recession, consumer credit deteriorates across the board and growth slows materially, I think the floor is around $18 to $20. But even in that scenario, the business would still be growing revenue in the low 20s percentage-wise and generating meaningful profitability. So the downside from here feels limited while the upside is substantial. My conviction level right now is 8 out of 10. I remain extremely confident in the fundamental business trajectory. The only reason I'm not at 9 or 10 is because of the near-term macro uncertainty and technical damage that needs to heal. For investors right now, if you have capital available, this is an excellent entry point in my view. I would start building a position with 35 to 40% of your intended total allocation at current levels around $20 to $21. If we drop down to $19 or below, add another 35%. Keep the final 25 to 30% in reserve for additional weakness or to add on strength if we break convincingly back above $22 or $23. Position sizing should be around 5 to 7% of a total growth-oriented portfolio because the volatility remains elevated. For current holders who are sitting on losses right now, I strongly recommend holding if your time horizon is 12 months or longer. The fundamental investment thesis has not broken. This sell-off is driven by macro factors and sector rotation, not by company-specific problems. The business is actually executing better than ever. For short-term traders, we're starting to see the very first signs of a potential bottom forming with this broader market rebound. But I would wait for real confirmation before committing capital. You want to see at least 2 to 3 consecutive days of solid gains and a move back above $22 before the technical picture really improves. This is a strong buy rating for patient long-term investors, in my professional opinion. The opportunity is genuinely wide open right now. The majority of stocks across the market are turning green after the massive drop. This is exactly the time to acquire high-quality businesses at cheap valuations. At $20 to $21 with these fundamental metrics, this is honestly a gift. Stay disciplined, everyone. Don't let short-term volatility shake you out of a high-quality, high-growth business that's executing flawlessly. Good luck to all of you. Please subscribe if you haven't already to receive my analysis as soon as I publish.